Hello, I'm David Cardiani and welcome to the RFA Weekly Market Update. Like a broken record, I'll say it again. Markets are sitting at new all-time highs today, fueled by a positive economic environment and a strong earnings season thus far. We're going to take a look at a few of those earnings releases in just a bit, but first let's take a look at this week's market results. We had the S&P 500 up 1.8% for the week, small and mid-cap stocks up 0.8% for the week, and international stocks up 1.7% for the week. Government bond yields were unchanged, and mortgage rates crept up a bit to 4.08%, while the dollar slid nearly 2% in strength this week, but crude oil above $66, a nearly 10% increase year to date. And then in economic news, we had weekly jobless claims coming at 233,000, slightly above last week's reading. And then we had economic growth measured by GDP, showing a rate of increase of 2.6% annually based on the fourth quarter's reading. And personal consumption inflation showed a fourth quarter growth rate of 3.8%, and core PCE, which excludes food and energy and is the Fed's favored measure of inflation, showed a rate of 1.9% as of the fourth quarter. And this is very close to the Fed's target rate of 2%. Then in housing data, we had home sales dipping slightly in December, with existing home sales down to a 5.6 million unit annual pace and new home sales down to 625,000 units. And in portfolio-related news, Union Pacific Railroad reported earnings per share of $1.53, which was about 1% below expectations of $1.54, on revenue of $5.4 billion, which was slightly above but essentially in line with expectations. They've been able to raise their prices to keep pace with inflation and expect lower inflation in 2018 to help improve their profit margins. They will be using the new tax savings to accelerate their share buyback program as well. The stock dropped over 5% after the release, giving up all of the gain from its January run, leaving the price nearly flat year to date. And then Microsemi reported earnings per share of $1.01, which was right in line with estimates, on revenue of $469 million, which was about 2% above expectations. The two weakest segments for the diversified chip maker were data center and defense-related products, both of which are expected to have some of the best growth prospects going forward, providing a positive outlook for 2018. The company is viewed as undervalued compared to its peers, and rumors have begun to circulate that it may be acquired, sending the stock up over 7% this week, where it settled in just below its new all-time high. And Honeywell, the industrial conglomerate, reported earnings per share of $1.85, just beating estimates of $1.84, on revenue of $10.8 billion, which also just beat expectations. The company is seeing increased demand across many segments and continually focuses on efficiency and cost improvements to increase their profit margins. They will direct their tax savings and repatriated cash of about $7 billion towards M&A with a focus on software. The stock is up roughly 3% for the week. And yesterday, Intel reported earnings per share of $1.08, blowing out estimates of 87 cents per share on revenue of $17 billion, which was 4% above expectations. Led by its high-margin data center segment, which saw a 20% increase in sales in 2017, Intel is poised for continued growth in 2018. Even their legacy PC business saw improvement. Their new tax rate will drop to 14% from 22%, providing an immediate boost to profitability. The stock is up 10% for the week. And next week we'll be in the heart of earnings season with many reports to cover and plenty of economic data to review. And then on Wednesday we'll have the Fed's next rate decision, which the market has assigned a 96% probability of no change being made to the benchmark interest rate. That's it for now. Thanks for watching. We hope you can join us again next week.